Good morning. Do you mind putting up the chart of the MOVE index to show where Treasury bond volatility is migrated to? I'm not sure if we have that.
No, but you can pull it up on your own. We don't want to get in the business of pulling up a chart of a price. No?
Okay. Here we go.
It started to move. Okay, so that's the thing about the move. It moves out when the Fed doesn't know what to do next. Okay, I think we do have a chart where I've explained this before, where we have on the X and Y axis, we have the MOVE index, Treasury bond vol, and we have the high yield. We have high yield spreads. So what happens in that environment? Actually, we might have. We do have a great. It's in a different deck, but in this deck in particular, we still have this great slide on slide maybe 32, guys, if my memory serves me correct. Darius was in here. He'd nail this like a Craig Louganis. Just a beauty. Darius is the best. 32, yeah, look at that. I still got my memory. I'm like Biden. There you go. So here, instead of thinking about the move, this is another way to still think about it. On the x-axis, we still have high yield. In this case, we have high yield spreads. So on the y-axis, we have term spread. So what's term spread? That's the shape of the curve. That's what the curve or the bond market's predicting the U.S. economy is going to do. And high yield spreads are the credit risk. Again, the credit risk when high yield spreads go up or they widen, and then again, that means that the credit profile is deteriorating, or the cash flows are deteriorating, people's economic outlook's deteriorating. So what happened in 07, and I made this call, obviously, maybe not obvious to all of you, but in 2007, the peak of the cycle, and as much as 2019 peak of the cycle, high yield spreads are down basically in the bottom left corner. Risk can't get any more complacent than that. It's pro-cyclical. By the time you hit the low of the economic cycle in early 09, it's out here. So that means that what happens is that credit spreads blow out, okay? Currently, we're here. We've blown out to here. And Powell's job is to try to drive that back here. But gravity wants to bring it here. Isn't that a crazy thing, right? Like so many of you people believe in liquidity, or Bernie and Biden, all this bullshit, right? When the reality is that central planners at this stage of every economic cycle, every single time we hit this stage of the economic cycle, which is in 01 and in 07 going into 08, the central planner becomes impotent. Impotent. You guys know what that means, right? Right? I'm not just trying to talk to guys, but you know. It's a bad thing, right? You got to find something new for that. And the reality is that it's not more cowbell at this point. That's what the market just said. So we're going to have to see about that, because literally, people, if you're long credit for this last month of a window, I don't even think it's remotely reasonable that somebody could have said, I bought high yield credit on Valentine's Day because the fundamentals were absolutely telling me to do so at the all-time high. That is crazy. Like whoever told you that should be fired, right? A lot of people are going to get fired, by the way, especially if this continues to widen high yield spreads. And the MOVE index in kind, which is your question, continues to move out because Treasury bond vol starts to go up because people don't know where the bottom is in interest rates because they're expecting more and more and more. And when they don't do more, they need more. So again, that's the point. The MOVE moves out, high yield spreads widen, and everything is, you know what?